Good afternoon, and thanks for remaining here, despite being a Friday afternoon. We have a very challenging topic. I introduce you to my panelists. Petri.
Thank you, Reuben.
Please. Christopher. Hi, Christopher. Thank you. Christos. And last but not least, Ulisse. Come. Just a little bit an introduction on the panelists. We have on my right Ulisse, who is Managing Director of APAC at Chain Analysis. We'll have time to discuss on how even this software can assist in what we're discussing today. We have Christos from the Malta Financial Services Authority. He's Senior Analyst there, and he is heading the authorization unit for the VFA service providers and agents and all the package we have introduced last year. Dr. Agius from CSA Group. He's in the board of directors of the legal and fintech arm of the group. And Petri, who has a wide experience as a finance person and an IT person. He is with KPMG, Cayman Islands, and he was in charge to develop the methodology for auditing digital assets. Today, the title, as you see, is the challenges we face to audit such digital assets, particularly when it comes both for financial audit, IT audits, legal audits, but we will see how they combine together. And we will discuss a few of the assertions surrounding digital assets in a balance sheet context. One of these assertions is the existence of such assets. And I'd like you, perhaps, Ulisse, to explain to the audience whether there are any tools, any IT tools that could actually verify whether the assets that is claimed to be owned does actually exist.
Yeah, that's a very interesting question. So one of the things that we do at Chain Analysis is basically creating the link between the real world and the blockchain world. So we basically map the blockchain and identify services, but also personal wallets that are connected to licit and illicit activities. So this is one of the ways we, for example, prevent money laundering in the blockchain, but also identify simply services and assets in the blockchain.
Okay, so having determined that this asset actually exists, one will also need to determine whether there are any inherent or business risks attached to that asset. Can this be done? And most importantly, what is the probability that there is a reasonable assurance to verify this?
So when we make this mapping of the blockchain, when we gather data and make attributions, we make the distinction between two different types of data. One is what we call ground truth data, which is basically data that is gathered manually by our analysts. So we have over 50 people that are actually making attributions in the blockchain to make sure that the services that we identified are actually the ones that we claim they are in the blockchain. And the second part is linked to our algorithm and heuristics, so more AI focused. And the combination of these two basically allows to increase the probability of identifying the services that we claim. So generally when we present a service or identify a service, attribute a service in the blockchain, we are very certain about the information that we provide. And it's this combination of manual and AI work that allows us to do that. Then when it comes to identifying potentially illicit activities, we have basically a list of categories that we have created to basically map the blockchain. So it could be, for example, darknet markets, or it can be ransomware, or it could be terrorist financing, for example. So an asset linked to these illicit activities would definitely raise a red flag for the regulators, for the FIUs, and for the cyber police officers of any country.
I had a few discussions with a colleague of yours who was around, and he basically said that his words were, no one can escape, in the sense that companies like yours and his can actually track from where this crypto or coin or whatever departed. And all you have to do is then identify the exchange to say to whom that particular coin relates. How realistic is that? Because we're departing from something which we all claim it's anonymous. And then this person here is claiming that no one can escape, in the sense persons like you will somehow identify. How correct is the statement?
Yeah, that's a great question. So if we look at the Bitcoin blockchain, for example, so Bitcoin is semi-anonymous. That means that basically, if you look at the ledger, the public ledger is open to everyone, so everybody can see the transactions. The transaction, the information that you can see on the transaction is time, date, and the amount that is sent, the outputs of the transaction. Obviously, it's very difficult to identify basically whether these are services or personal wallets, for example, and who is behind these transactions. Chainalysis does not do any KYC. And transaction monitoring companies generally do not do KYC when it comes to like AML transaction monitoring. What they basically do is provide information on whether it's a service or a personal wallet, put them in categories, and then it's up to the exchange to offer KYC services to identify the specific person who's connected to illicit activities. So for example, if we were to identify illicit activities connected to an exchange, let's imagine that a law enforcement agency would use our software. They would basically issue a subpoena to an exchange, would then have to provide KYC information to this KYC information to the law enforcement agent. So like this is basically the path. Obviously, we could also talk about suspicious activity reports and all that. But the important thing is to make the distinction between what KYC information is provided, so exchanges, and what we can provide is information on chain.
Okay. Thank you, Ulisse. Petri, you have been in charge of developing this audit methodology. I'd like to discuss with you, perhaps, because another assertion within the context we are saying is completeness of what there is in the balance sheet, whether the company has reported or the entity has reported all the virtual assets it has. I'd like to know your ideas on this and how it came into your methodology.
Yep. So I think the advantage we almost have here is with the technology, because the technology inherently allows you to actually confirm the completeness. So in a blockchain, you've got a immutable system of all the transactions. So completeness of all the transactions that happened in a specific address is actually quite easy. From the beginning of whenever that address was used the first time, you can see all the transactions. And by relying on that technology, you know that all the transactions have been accounted for, they are on the network. The other side of that as well is when you're looking at a specific private key. So a specific private key might have multiple addresses associated with it. So their completeness, it's a little bit more tricky because maybe someone is showing you one address, but the other addresses they haven't disclosed to you. But if you look at it, you have something called the public key or the XPub in Bitcoin, for example. And if you can get that public key, you can then identify all the potential addresses. So then without any question, because it's math, you know that you have completeness. You can actually confirm all the addresses. You know you've got all the transactions. So building the tools to be able to do that is challenging, but relying on the mathematics, you actually can say it is complete with much more certainty than traditionally.
Okay, so in a traditional environment, rather than a normal environment, we would have registries, like in the case of Malta, in the UK Companies House, in the case of Malta, the Malta Business Register. So it is actually easy for a person trying to find out the links the company has through that public information. Doing that comparison for the sake of simplifying things, how easy is it in the context you're saying?
So in terms of building the links, that also becomes easier because you've got the public blockchain, and you can actually see all the transactions. In the traditional system with banking, you'll see transactions going out, but you have no visibility of what the counterparty was, etc. And I think that's where other technologies with the big analysis come in. You can then see exactly where things have gone, and you can understand what links there are. Because when you're working with a client, you'll work with them, you'll find out what the transactions were, and you'll roll all the transactions. So for example, if they say this was a transfer to the exchange, you'll be able to then have an API call into the exchange, and on the other side of that transaction, you'll see the transaction in the exchange. If they say, I sent this to another wallet that I own, they should be able to prove to you they own that wallet, and you see that transaction going through. So you can get that full picture.
So, because again, I'm always doing the comparison with a traditional environment. So if it's 31st December and we're closing off the accounts of the company or the entity, whatever it is, in a traditional environment, I would have a stock exchange that closes at 5 o'clock, and I have the rest of the day to ensure that. In a real-time environment, how do you manage cut-off at midnight on 31st December?
That's one of the very interesting things in this space. If you look at Bitcoin, for example, I mean, it trades on a few thousand markets all across the world 24/7. If I had to take Apple trades on the New York Stock Exchange at 5 p.m., you've got a closing price, you know exactly what it is. So in accounting, you've got something called principal market. So one of the challenges is you need to identify that principal market to get a price, for example. So you need to look at the markets, determine what it is for that specific asset, and then you need to determine what price do you use. Because the exchanges run 24/7, their time might be UTC or whatever, and then you need to convert that. And that becomes an accounting policy for each different client to then determine that specific point where you do that.
Thanks for that, Petri. Chris, I'll go a little bit into another delicate area, which are the rights and obligations tied to an investment. If I invest in a company, traditionally I get rights through its memorandum and articles. I have the right to attend to a general meeting. I have the right to see the accounts. How one can relate this to the digitalities in the sense, do the same rights and obligations exist in this?
I think when comparing virtual assets with perhaps more traditional type of instruments, I would say that there are quite similarities in the sense that obviously before issuing a particular virtual asset or perhaps acquiring one, obviously there would have to be some form of due diligence exercise where you try to identify the characteristics of that particular token, and obviously these would be derived from either the offering document of that particular asset or otherwise through the network's protocol, depending on the nature of the token. So obviously there are a variety of virtual assets ranging from pure utility tokens to security tokens. Obviously depending even on the jurisdiction where these tokens would have been issued from, there also might be variations of regulations which would apply. So, for example, if you had to look at the utility token or the payment token, typically in the past, these were issued in an unregulated manner. So these would be governed either by a white paper specifically associated with that virtual asset, and obviously one would read through the white paper and identify the various rights which would be derived from holding that particular virtual asset. Technically speaking, security tokens are perhaps slightly different in the sense that if you had to look at the European Union, for example, if you're doing an offering of a particular virtual asset to the public, then there are certain restrictions in place and you have to make sure that the offering which you are doing is done in a proper manner. And as an investor choosing to contribute towards that particular project, obviously when it comes to security tokens, there are going to be very similar rights to those already existing within financial instruments. So if you had to take Malta, for example, Malta, if you're offering a security token to the public, you'd still have to go down the route of the prospectus directive, meaning that many of the rights which are there to protect the investor for traditional financial instruments are also being applied to security tokens. So ultimately, I would assume that the way the industry is heading towards having more concise black and white rules governing the rights of these tokens, ultimately we are going to see an ecosystem whereby people are becoming more informed and making more concise decisions on the type of virtual assets that they acquire.
From a legal perspective, how can I protect myself, or what are the actions I could take if my ownership of the asset is challenged, or I feel that any of my rights have been breached in the context of what I was presented to what is actually happening, and is there any case history on this, court case history on it?
Yes, so obviously we are still speaking about a relatively new market, so many of the tokens out there are still relatively new, and some of the rights which are associated with holding that particular asset are either still going to arise. If we're speaking about a utility token which was issued in an initial coin offering, obviously the purpose behind that was to raise funds and then use those funds to develop the underlying project. So obviously the person who would be invested in that particular project are doing so on the premise that in the future they would be able to use those tokens against the goods or services being offered by that particular project. Likewise, when it comes to security tokens, there are going to be rights stipulated in the offering document. So when there are going to be conflicts as to whether the rights are being delivered or whether the rights have become due, one would go about it in quite a traditional manner. So if there are terms of issues and there have been token sale agreements signed by both parties, then obviously if there's going to be a violation of that particular agreement, one would be able to go about it legally and judicially in the traditional manner by suing that particular issuer. So obviously one again has to look at the jurisdiction where such an offering would be taken place. If you had to look at Malta, for example, they are putting in place very intricate rules so that there would be no confusion as to what happens should, for example, certain milestones not be reached. So basically we have to look at each and every case individually and then ultimately look at the best manner in which to go about it. Obviously in the past, given that it was an unregulated manner, there are areas where they were based primarily on disclaimers, so their investors are less protected.
Thank you, Chris. Christos, in the light of the difficulties or challenges that we have been discussing here, you have a very important role because you are part of the authority that is regulating all this, basically. How do you feel your role, how important is your authority's role in ensuring transparency, protection of rights, and what have you?
This is a very good question. Actually, we definitely see merit in investor protection, market integrity, and this was actually the reason behind the introduction of the virtual financial assets framework in Malta. Essentially, in Malta, we say that yes, certain crypto assets would fall squarely into traditional financial services legislation. However, there is quite a wide number of assets that merit their own distinct regulation, and this was the rationale behind the introduction of the VFA framework. And the rationale behind this introduction was to achieve investor protection and market integrity, which is something that we think that we have achieved to a certain extent. Now, there was a panel yesterday on whether we have over-regulated or not. Obviously, this is something to be tried and tested. But if you see closely the framework, you're going to see that the high-level principles of traditional legislation are enshrined in the VFA framework. Therefore, when it comes to disclosure of information, because informational asymmetry is something which is very common in this area, we have tackled. When it comes to market abuse, we have touched upon that point as well, and so on and so forth. These are just certain examples. Now, when it comes to regulation, and the introduction of regulation is only one piece of the puzzle. It's all good and well. These are just words. The main issue and the main question mark is how this regulation is going to be implemented in practice. And this is where the million-dollar question lies. We think, and we are saying that essentially we are seeing a transformational age in relation to financial services. However, this needs to be followed by a transformation of authorization and supervision from the regulator itself. And this is what we want to do, and this is what we are and will be actively doing. I don't want to keep it very high level, so I'm just going to give some very, very brief examples. We are running out of time, so I'm going to try to be brief. When it comes to authorization, one kind of emerging technology that we can see is AI and machine learning or digital identities. When it comes to supervision, we can actually see some data aggregation providers that they can feed us with information in relation to pump and dump schemes. If market manipulation is taking place, we need to embrace technology, but we should not be staying only inwards. And we are actively trying to adopt it, and we need to transform our authorization and supervisory function, and this is where we're seeing ourselves going.
I'll ask you a cheeky question. The industry is obviously continuously changing, and as you have done, legislation needs to keep coming in and updated. How open for us in Malta? It's easy to answer the question, but for the crowds maybe coming from other countries, it's not. How open is the regulator in Malta for consultation and in taking on board ideas that could be eventually assist you in developing further legislation?
We are very much open to discussion. We are very much open to consultation. As a matter of fact, most of the documents, most of the policy decisions before coming into force, firstly, a consultation document was published, and after the feedback that we have received from the industry, some feedback was taken on board, some feedback, obviously, that do not fit in 100% from a regulatory standpoint were not taken on board. However, they were taken into consideration on how to achieve the same level of investor protection and market integrity whilst not stifling innovation. And we think that we have managed to find a happy medium.
Thank you, Christos. One point we have not addressed in this panel and the assertions is the valuation of the assets, but we are totally out of time now. So we will not be addressing that in this panel, maybe another session. The speakers all are available on the stands out there, so should you wish to visit them for further discussions or questions, please, I am sure they will oblige in assisting you. One last thing, one beautiful thing MFSA has introduced is tying continuous professional education with licensing. In my capacity in another role in the Malta Institute of Management, we believe a lot in education, so we do encourage you to follow the courses listed within MFSA and obviously the courses listed at my institute itself. This week we are offering during Delta Summit a free course on MAL for VFA issuers and with VFA service providers. So you'll find these flyers around. Should you be interested, please contact the Institute. Thank you very much. Thank you to all the panelists for an interesting session and hope to see you around and discuss further. Thank you.
Thank you.